Hello and welcome to FP Markets 2019 Outlook for FX, events, links and trades. It's presented by me, Evan Lucas, for FP Markets. As always, when we do these, please, by all means, have a very good read through of the disclaimer on screen. Everything in this video and in this webinar is general in nature. None of it should be taken as any form of personal advice. We do not know your financial situation or your financial goals, and therefore nothing in this should be relied upon as any form of advice. For that reason, it is just general in nature. What I want to go through for this video and for FX for 2019 is the four currencies that I watch very, very closely, and the four currencies that I think have actually quite a lot to tell you about where 2019 will go, where financial conditions globally are moving, how that affects FX flows, and how that'll actually affect the setup. So I really want to go through USD, the pound, the euro, and also the Aussie. And I really will highlight very clearly that in the end, everything does always come down to the US dollar, and I think that needs to be your base case, and that is probably fine in terms of how you look at it. But again, it does therefore also mean it feeds into other things, and how that actually looks will also be part of your thinking. So with that, let's have a good start and have a look at the US dollar, because I think all roads lead to it. Your shaping of financial conditions globally comes around this currency, and we all know that. We all understand that. It's now about how do we evaluate what happens in 2019, probably against 2018 and 17. We all know how strong the US dollar has been over that period. It's what will happen now going forward. And there's a few things that have certainly changed in that space. And what I really want to show you is that if we have a look at where the Fed was at just before or leading up to their last meeting and to where they are now, the change is quite dramatic. And I think you really need to have that in the back of your head in terms of what they were projecting, how they were forecasting the outlook for the federal funds rate over the next 2 and a bit years compared to where we are now. So don't look at the 2018 number, obviously. We already know what happens there. They did raise rates again by 25 basis points. It's 2019. And having a look at that median number, the Fed Fund Futures expectations from September and the Fed Fund Futures expectations from the market the day before that last meeting. So that green and purple line. Because why I want to highlight it is that the Fed continued to tell us, and still does, that it's data dependent, but it's clearly not just data dependent, it's data dependent and market dependent. And that's why this is such a dramatic change. So that is, and this is the new outlook for the Federal Open Committee. What they did at the December meeting, you can see all those dots there at bar 2, basically agreed to raise the federal funds rate by those 25 bips they talked about, but it's the drop in the 2019 expectations from before, and then the market and where the market currently sits on that pricing. And I think that is what you need to look at to start this whole idea, this whole forecast for 2019 around particularly the US dollar, considering how strong it is against everything out there, is that you can see the federal fund futures now are actually talking and are forecasting the probability of a rate cut next year and even into 2021 that it could happen. The probability of a rate rise as high as what the Fed is talking about there. So the median number is talking about the federal funds rate jumping up 2 times. Market isn't telling you that at all. It's actually expecting rates to remain on hold for the rest of this year. And that is the difference. And what we've seen, and over particularly the last 4 to 5 weeks, the communication from the Fed actually probably meets the market rather than what they're actually forecasting. And even with their last update, which happened back just on January 26th, 7th, was that you can hear their moderation. They are data dependent. Financial conditions have certainly tightened. They still are very, very excited by the whole idea around the employment market, that growth has remained above trend, but the financial conditions globally have tightened to a level that actually has probably made them stop. And I think that also is the way to look at this in terms of what you think, is that the outlook for the Fed has certainly changed, and the outlook from the Fed has certainly changed. And that in itself means that I expect US dollar moderation through this year. And that is certainly what we've been starting to see. And that's my base case, is that having had such a stellar 2017-18, moderation is probably very likely. So the thing about it, though, is that with this change from the Fed, with this moving away from raising rates at the rate they've been doing and the expectation that they could have even got as high as 3% come December this year, there is now a change also. So financial conditions aren't going to be as tight. The moderation cycle isn't going to be as fast. The exit out of the US dollar and therefore out of the US economy will probably slow down. So this is the next thing, is that growth, yes, it's going to slow down. And yes, there is parts of it. But again, what we've seen is that the market actually probably drove the Fed here. And that's why I want to bring you to this chart. So this here is the US benchmark, obviously the yield curve. From 1 month all the way out to 30 years. Again, I want to do the same comparison between what was happening leading up to the December meeting and what has happened since. And everybody was highlighting this kink in the curve, particularly the difference between the 2 and the 5 year. And the fact that it was actually inverted. This is why everybody starts talking around recession, why everybody's getting really nervous around what is going on, why the forecast around growth that they have is possibly not actually likely to be as achievable as they think. And what has happened since the Fed has raised rates but also changed their communication is that kink in the curve has got even more interesting and slightly more dramatic. So it's narrowed. That's what you've got to probably take out straight away. You can see that it is narrowed. It's not as high. The 2 year has come down. The 5 year is about par. But you can also see, going back to that federal funds dot plots, if you can remember that chart before, that the 1 year being obviously inverted to the 2, 3, and 5 shows you very clearly that the market suggests that maybe, yep, they could do rates one more rise this year, or at least in the short term, but over the medium term, they're going to cut rates. And that, again, gets back down to this fear that a recession is going to happen sometimes 2019, 2020, 2021. We're only looking at this year and thinking about this year, but that is obviously a moderator. It is also a bit of risk. If you're adding that into it, it also therefore suggests downside. So the US dollar moderation and that market / data-dependent Fed is certainly coming into it. And I actually believe that this has forced the Fed's hand to back away from its rate hike path. That is clear as well. And that's why this chart, I think, is so important, is that you can see the change from what it was previously leading up to that number to where we are now. The flattening and the slight inversion between the 1 and the 5 and the 1 and the 2 shows you that the Fed has obviously had to react to that. So it then asks the questions, what's happened? What's happening? What's changed? Where are we getting it? I think this chart from Goldman Sachs is a really good way of looking at that moderation. So this is their current activity indicators that they have, and they're really, really good because they take into account their leading indicators, PMIs, any sort of surveys around business conditions, confidence in conditions as well, consumer spending, all that kind of stuff they take into one indicator. And you can see there's been quite a sharp decline in their soft indicators. Soft indicators are things like PMIs, PPIs, consumer confidence. Their hard indicators are more actual data, that is retail figures, non-farm payrolls, all that kind of stuff. And the interesting thing that you can see there is, although the soft indicators have broken down, there is a bit of a tick up in the hards. And that in itself is why at the moment there is a bit of push-pull to this. And the moderation sort of outlook that I have has probably started to slow down a little bit because now with the Fed likely out of the market, what does it mean for growth? What does it actually mean for US GDP and how that actually looks? I think that's actually probably a really key question, because why I say that is that although this is starting to happen and you are starting to see these soft indicators and this hard picking up, which one has a bigger impact on growth and which one has a bigger impact and outlook on it? You've got to still can remember that non-farm payrolls are absolutely humming along. And I do mean that, straight out. They are humming along. Employment in the US is very good. Wage growth is pretty strong. It's averaging around about 2.4, 2.5%. It's as high as 2.7 right now on a month-to-month basis. So wage growth is still there, and that's despite all this. And despite all the concern around tightening of financial conditions, tightening of spending, consumer confidence maybe taking a slight hit, all of that's there. But the difference is that we're not going to probably see growth really fall away. Now, with this chart, this is from the IMF, and I'm sure you've all seen it. I want to put a bit of a caveat in here. It doesn't take into consideration the impact of what probably will have happened from the government shutdown that we've just seen. So that needs to be taken as a one-off. It will probably therefore mean that cyclical issues will come through, and Q1 is probably likely to create a bit of volatility when it gets released at around about April, May, and will probably distort the data. But in the main, if you look at this and you look at the states from 2018 to 2019 expectations, yes, it's slowing, but it's moving back towards trend. And what you also need to look at is that if you compare 2019 projections to 2017, it's still above. And 2017 was a stellar year. Growth was incredibly good. It was on the way up. It really took off and has, held through 2018. And look, there's no doubt it peaked out. It's now moderating. And that's my story. And that's my thesis around the US dollar, is that you've now got a bit of moderation. And there's nothing wrong with that in terms of how it looks. US dollar and Dixie particularly will probably start to ease off, but that's fine. And that's why, and again, looking back and using this time frame about how I'm looking into 2019, this was Dixie leading into that December meeting and what we knew just before that about where they were heading. And look at the strength that you can see there. I mean, basically since May last year, the strength in the US dollar has been incredible. The takeoff has been very, very strong. The uptrend has always and had been maintained. And even since then, this is what's happened since then. The moderation has started as I expected, but I'm not expecting you to see Dixie falling back towards, your 89s, your 88.5 levels. I'm expecting moderations to see Dixie at around sort of maybe 94, maybe even as low as 95, or 3.5, depending on what happens in the other currencies I'll discuss later in the presentation. But this shows you very clearly that that is there. The reason I've highlighted emerging markets versus the US dollar, the alleviation of financial conditions is actually a positive for them. And that will be quite interesting. So US denoted debt won't be as expensive. The pressure it puts on those economies sort of drops away. Their ability to actually continue to function the way they are and probably continue to be the growth engines of the world will be up. So just keep an eye on those. They are exotic. Remember that. They're not the easiest things in the world to trade, but they are certainly something to watch. And again, they will be probably part of the moderator, but they're not a huge part of Dixie. The other part of it is, again, the euro, and I'm going to come to that in a minute because the euro is quite an interesting one and quite different in terms of how it looks. But all in all, my overall view of 2019, the US dollar should moderate. We know that. We know that the Fed is now probably out of the market, so that hike cycle is slowing down. Therefore, the heat that probably comes with flows from that will drop away. And all of that would suggest that the US dollar should moderate, with the caveat being that if growth beats expectations, there will be investment dollars that want to head to it. And that therefore will probably put that floor. It won't therefore let it drop back to May levels anytime soon. It will be more of an attraction on an investment basis rather than just on a monetary policy and on an economic basis. So let's move on to the next sort of pair, and particularly considering this is one that has been quite interesting, it's the euro. And at the moment, it is racing to the bottom. The change in the outlook for the European Union, the change in the expectations around growth being a big driving engine of manufacturing and exports has been quite astounding over particularly 2018. And I think that needs to be your base case in where we sit. It also needs to be your base case that the euro at the moment has got a whole range of things against it. Despite the fact that it should be actually quite attractive. And what are they? Well, let's have a look and go back to that chart that I showed before from the IMF from the US. If we scan down to the euro area, you realistically just have to look at the big four. And even taking out Italy and Spain, let's just look at the big two and have a look at Germany, have a look at France. What is happening in their outlook of growth? The fact that Germany surprised everybody with having that negative quarter in the third quarter. Yes, you can argue it's a perfect storm with some of the headwinds it's facing from the US, particularly with possible sanctions around automobiles, sanctions around European financial institutions is a drag, there's no doubt, and that could ever be an arbitrary mover that gets alleviated. So that therefore could reverse this. But in the main, if you look at the overall activity center coming out of Europe, it's slowing. The renaissance that we had hoped for and were expecting, and I personally had been looking at the euro and the European Union as a good growth engine in 2018 that was coming from a low base, was showing signs that all of the work the ECB had been putting into place for the 5 years before that was coming to fruition. Unfortunately, just hasn't manufactured the kind of levels that you'd expect. And that's really clear. And therefore, looking at the fact that Germany could be falling back to 1.3% growth, France moderating, holding the line to some extent. You then look at Italy and Spain and where they're moving is also part of it. Italy is also likely to cause gyrations. And I don't need to get geopolitical on this, but clearly what is going on with a very, very populist anti-EU establishment party in power and likely to hold power for the foreseeable future is also just at a level of risk that's also putting a negative on the currency. And that makes complete sense in terms of where you are. But let's stay on the growth story. Let's stay on the output story. This comes from Macquarie, and I think this chart perfectly sums up why the Eurozone at the moment, it just isn't as attractive as it should be. And you can see very clearly that the consistency that was happening in 2017 has dropped away in 2018. It's likely to continue to do so in 2019. And that is an immediate negative to the currency, considering, as I said to you, it is an export nation sort of zone. It very much relies on that as its major drivers. And you can see that what's going in there is moving in the wrong direction. And look at Germany, look at France. You can see them in the dark blue and the light blue on that right-hand side. They are moving in the wrong direction. Italy also has been in and out, but again, the big two are the ones to watch. Now, there is a silver lining and a positive to this. A lower euro does therefore make European goods more attractive. Therefore, GDP on a net export basis should improve as the value of exports therefore get picked up once you repatriate back into euros. However, it doesn't overall patch up the issues around consumption and private investment in the European Union, which are unfortunately not moving in the right way. And then if you look at the next thing and look at those leading indicators, those soft indicators we talked about with the US, these are things like consumer confidence, the PMIs. I know this chart's a little ugly, but again, it shows you where 2018 headed. And again, you can make the argument that this is geopolitical. The fact that the president did single out the European Union for possible tariffs around some of the biggest industries that come out of that part of the world is unfortunate. But that has therefore had a flow-on effect, and it has affected the overall scenario in the European Union. It's affected the overall confidence of the average consumer and the average business in the European Union, and that is therefore feeding through into what's happening in the euro from a macroeconomic viewpoint, and that is why it's certainly something that you're sort of not that excited about. So that also therefore brings me to the next point and where the ECB is and why it's becoming a little bit clear that it's not so super. Things are not moving in the direction that they were expecting. So I want to highlight these 5 points that came out of the ECB's latest meeting, and I think it is a very, very good point and a very big setup for what this year will be. Because remember, before we had this meeting, the probability of a rate rise from the ECB was probably sitting at around about 65%, somewhere from around about August onwards. The probability of seeing more Litros going in was also a little bit lower, probably around about 40%, which is a good thing. So that's a tightening cycle principle. We're probably not there anymore. So if you look at the top one, the activity data, weaker external demand, countries and specific factors are filling through to it. So we know this. We know that incoming activity data has been softer on the near term, weaker external demand, country-specific factors. Look, they're judging that there's partially a transitory nature. That's fine, but at the same time, it hasn't really come through. Now, you do have favourable labour conditions over there. You do have lowering energy prices. There is a euro expansion, so that is a positive. But in the main, they're not great. You've also got persistent trade issues. And that's been happening for a little while now. There they are, again, the acknowledgement between the periphery and the core, the differential of purchasing powers, the differential of manufacturing powers, pricing powers have come through. But Brexit actually filters through very clearly into Europe. And the one I'd actually like to really highlight out of this is somewhere like the French champagne providers. And I know that's a really strange one to take, but the reason I say that is that removing France, which is the largest consumer of French champagne itself, their next biggest market is the UK. It's not the US, it's the UK. The impact on the French region and the impact on that kind of number is huge in terms of the ability to get some form of deal that actually works for the European Union and also for the UK is obviously very, very hard, and I'll come to that in a minute. But at the same time, it just shows you how much of an influence the Brexit deal will have and how intertwined the UK is for exports to the European Union and vice versa. So that also needs to be part of it. Inflation forecasts remained unchanged at the last meeting, but at 1.2 to 1.4, this is historically low. There isn't any reason with inflation at that kind of level to really be chasing increases in monetary policy to tighten it up. I mean, that's the main goal of every central bank across the globe, including the Fed. They have extra mandates, whether it's employment et al., but in the main, most central banks' job is to control inflation. Inflation at 1.2, 1.4%, I would argue that that's low, and that therefore the reasoning to tighten is pretty hard to argue with that at the base. They are considering long-term refinancing operations, so LITROs. It's again to address the fragmentation across the European Union's banking sector. We were hoping, and most people were hoping, that they wouldn't have to continue on with the Europeans' version of QE. That is, again, stimulatory, more euro printing, therefore euro perspective, it will bring a lower movement. But in saying that, despite all that, the council is still reiterating its forward guidance, and it's still reiterating the idea that it could probably hike at the end of the year. Those four first points would be an argument that's hard to make, but that's certainly where we're sitting, and certainly something to keep an eye on in that space. The other thing, the only time I'm actually in this whole presentation going to get a little bit political is what is now likely to happen around the European parliamentary election. I'm going to skip over that first slide. I want to actually come to here and have a look at the reason I want to show you this, and the reason I want to talk to you about this is, again, the Italy story is not just an Italy issue. It is clearly spreading across the whole zone. These here, and this chart by Goldman Sachs, clearly shows you there is a very, very big drive towards populist movements in Europe, and particularly in the region. So look outside the major cities. The major cities tend to have a view that is one way. It tends to be a little bit more liberal for obvious reasons. But out in the regions, that switch around is quite large. They are also more affected by globalization, by the movement of things like manufacturing jobs, etc. Therefore, they are more likely to move towards populist principles and to move towards more protectionist ideas. And the reason I highlight the Parliamentary Council is because with Brexit going ahead, you therefore will see the dissolving of all of the UK's holdings in those seats. And a lot of them are distributed, not all of them, but the majority are going to be distributed across the European Union. The one to watch, France, and that's why I've got this slide up, Marine Le Pen's party is clearly on the rise. Her possibility of grabbing additional seats in the European Union parliamentary elections are getting larger. You need to also have a look at places like Hungary. They are clearly on the way up. Poland as well. And the reason I highlight Hungary is that it's actually going to get an additional 2 seats from the dissolvement of the UK's seats in the European Union. And you then also have to look at what's going on in Italy. They will also grab a few additional seats, and we know about the 5-star movement and where they sit. So populist parties with an anti-EU agenda sitting in Brussels is a risk, and it creates risk that is more likely to present downside to currencies and downside to growth than sort of having a look at any other way of looking at it. The other way to look at it is the other way around, and this is, again, the support for centre and slightly left of social democrat parties over the last 2 decades is clearly sliding at quite a rapid rate, and that in itself was also very interesting. So not only could you see a Marine Le Pen sort of version-styled populist party pickup, you could also actually see quite a loss on the other side. Politics aside, the reason that's interesting is that, again, it also means that policy decisions can actually move in a direction that hasn't seen Europe move in that way for quite a long time, and that creates disruption. Even if it is business positive, it doesn't matter. It can create quite an interesting disruption. So what does that therefore mean? As I said, it's a race to the bottom. And this is why, again, getting back to my first part of this talk around the US dollar, the moderation is going to be there. But remember, the euro dollar is one of, if not the largest driver of Dixie. It's about 27%. So you've got to remember that. And therefore, if the euro is racing down against the US dollar, it will moderate that out. And I highlighted again, I keep taking this time frame deliberately. December leading up to the Fed and where we are now. And you can see that there was a interesting sort of descending triangle that was going on there. But in the main, I expected it to move sideways, and that's what we've seen. So there hasn't been a huge movement in here. Basically, if you have a look at that December meeting, we were coming in here, it popped up, come back, and basically sitting dead center. And that, again, is the US dollar story. The US dollar wants to moderate. It wants to get away from how strong it's been. But the European Union's scenario, the Euro scenario, is pretty negative, and they're fighting each other. And you could therefore see quite a sort of horizontal translation. But it's a question of how much disruption happens in 2019 and whether or not the euro goes back to 112. I'm not sure it can. It would certainly help exports, but there would have to be some pretty bad volatile events to do so. But what I'm also arguing is that seeing it at 120 is very, very unlikely with what's going to happen this year. And therefore, if you're looking at it from a trade perspective, it's more likely to translate on a horizontal sort of axis and you trade around that rather than there being a large appreciation or a large depreciation. So let's bring it to what's basically been dominating FX markets for quite, the last 2 years, but realistically been dominating for the last 8 months. I'm going to put my hand up and say this very clearly. It's very hard to forecast the pound at the moment. 2019 is going to be all about what happens realistically in the next 3 months. And I think that needs to be our base case. At the moment, and I've put this out very clearly, that in what has happened in the last 3 to 4 weeks even has made the pound very, very risky, and trading in it is become quite so. I have been and still remain of the view that 2019 is likely to see a net appreciation of the pound. But leading up to the 29th of March and what could happen over the next few weeks has made being involved in it right now quite tricky. And the reason for that is for the following reasons. So let's start, as always, with the economics. Let's start with the view around what that means. This chart that came out from the Bank of England at the back end of last year, I think, is beautiful. It really explains why Brexit is so disruptive to everything and anything that is associated with the UK. So it's not just the UK feed out, as I've said before, the feed out into Europe is also there, but it's also how you look at it from disorderly to disruptive to a close Brexit to an economic partnership, etc., etc. And you can see how this looks in terms of the expansion of UK GDP under each scenario and whether or not you actually see quite a fall away for 2019, a fairly linear movement in the same direction, or whether or not they actually get a partnership deal like a Norwegian sort of styled EU number. All of that has been factored into this. Now, the Norwegian styled EU sort of Brexit looks unlikely and still remains that. However, there was a period there about 2 or 3 weeks ago where it could have happened, considering that there was suggestions that pro-EU Tories could cross the floor, form a Labour government and have Parliament take the Brexit negotiations away from the Prime Minister herself. That looks less likely now with what's been negotiated over the last couple of weeks. But in saying that, it's still there. At the moment, from where we sit, we're probably looking at this scenario here. It's going to be disruptive. It's certainly going to have an effect in 2019 in what we see, but it's not going to be as disorderly as possible. It could be disruptive, but I see it more happening in here with what's now happening. They are moving towards a deal, but again, there's some few moving parts at the moment that just make it tricky. And what I want to continue to show, this shows you how volatile the US market, the UK markets have been, whatever you've looked at in terms of being involved with. But as you can see, cable there has started to really move up, and it should in terms of where it's been. It does and still has a base case scenario of a deal being done. So that needs to be your bolt behind it. The interesting thing, and I know I'm moving away from what we're talking about here, but about why I show the FTSE 100 is that if you look at the FTSE 100, pretty much, in fact, almost all of them have the majority of their earnings from overseas. So the falling pound has certainly been beneficial to them. The repatriation of quid back to the UK has certainly helped and had an FX tailwind to earnings. So that's also part of this as well. But if you look at it inversely, if you look at the domestic exposed stocks versus the internationals, and then the trade-weighted numbers of the pound, it's the complete opposite. So those in the 250 have really found this difficult this period, and it has been basically, you can see, since the fall away, since Brexit vote itself back in July 2016, they have not recovered. And that's the impact that Brexit has had and will have continuing on once this gets done, if a fairly disorderly exit happens. And that, again, this is a chart that just shows you exactly what I was talking about, the difference between the FTSE 100 and the FTSE 250. So, Article 50. And the reason I highlight Article 50 is because it's becoming more and more important. It's becoming more and more important for the pound in the short term. So, I've put up here some points that you need to have in your head around what might happen over the next 2 to 6 weeks, leading into the 29th of March, and how that is. So right now, PMA is clearly trying to start negotiations with the EU over the backstop and with the bloc's leaders. It's not going to plan, let's be honest. The EU is holding firm with its current view around the backstop. If you listen to Brexiteers in the UK, they want the backstop gone and want some form of deal of electronic transferring across the border between the Republic of Ireland and Northern Ireland. And it is a massive sticking point in terms of where we are. You've also got to remember the DUP, so the Democratic Unionist Party up in Northern Ireland, are very much of the view that they need the backstop gone, and they are a big part of the coalition that forms the Conservative government in the Commons. There's 10 of them there. PMA needs them to get any form of deal across the line, and they are sticking to their guns. So quite interesting. Now, next week we get an update to the Commons. Hope is May will come back, obviously, with a revised deal. There is suggested, currently mooted, could change, that the MPs will have another say. Then it's likely that there will be a second meaningful vote, and that in itself was interesting. I know everybody would have seen what happened for the first meaningful vote, which realistically, in my view, is actually the second, considering the first meaningful vote was just completely postponed back in December, and how heavily defeated it was. If this one is defeated, then we are looking at Article 50. March, Brexit deal passed into law, blah, blah, blah. And the reason I put there the catch, Article 50, which is triggered on the 29th of March, needs to be agreed upon by Brussels. All of what we've just discussed has to be agreed upon by Brussels. If it is not, and it looks unlikely considering what some of the proposals are happening, Article 50 needs to be moved. Now, the European Union has history on this. They probably will. So again, I am net long the pound because that would be a positive. It takes the pressure away. But in the middle, right now in this transition phase, it's pretty risky. And it is very hard to sort of get that, which is, again, why I'm slightly out. And I'll show you that in a minute, why I'm sort of nervous around this whole idea. So this here is the pound over basically the Brexit transition. So you can go back into the July numbers. You can see that big fall down when it was at $1.50. And I remember sitting on the trading floors and watching it. It was an astounding day, and I'm sure you'll remember it. And what's translated since then, and where we find ourselves now. And if you look at it, since this chart to here, we have been net moving in a right direction, because it did always look like and did always appear that something would happen, a deal would get done, and we would get through this. What has started to happen, though, in the last 3 to 4 weeks is risk events have caused quite a lot of gapping, and you can see that. So have a look at the start of the year. Then you can have a look at around the vote that happened back in midway through. So it was around about the 15th, 16th of January. We had the issue around the first meaningful vote. You've had MPs resign. You've had MPs cross the floor. All of that's created some fairly volatile periods, but it was moving in the one direction I expected, which was net long. What we've now got a scenario with, though, is that the European Union is involved, and that Article 50, although I believe they will move it, is becoming political. And that's why you see this moderation away from getting up to as high as 132.5. You've now got a scenario in cable where there is some vol, there is some rocky events that could happen. The Commons could do something quite wild, and the same with Brussels. I remain of the view for 2019, a Brexit deal will happen. We will see the UK transition out of the European Union over the next 2 years. The question is when and what happens in the interim. The net effect from my view, though, is that the pound over that time will probably appreciate and likely see it move back towards 134, 135 over the year. Could even be higher depending on how positive the deal is done. And that's basically my base case. But I'm waiting to see how the Brexit final stages translate before I actually probably get back to it. So, final currency to really look at, and that's the Aussie. And it's one obviously that I know quite closely, considering that I am based in Australia, and I do follow it very, very closely. The Aussie is an interesting one, particularly for those of you watching it from overseas, because domestic economics and what happens in the Aussie don't necessarily match. So that's what I want to talk about. So does the economics and the pricing match? And the argument would be they don't. So this is the latest, what we have here, which is the NAB business confidence numbers. It's a very good gauge and followed quite closely. And for even during, the volatility that happened at the back end of last year, it's been pretty strong and has been for several years. And you can see that it normally sees particularly conditions being quite strong. You also tend to see that confidence, even in the lowest depths of the periods, remains actually quite buoyant. But what we did see at the last update was an absolute collapse of sentiment. It wasn't highlighting just mining or just retail or financial services. All of them moved from conditions of just under 15 or pretty much on 15 to 2. And it was in profitability, it was in trading conditions, it was in employment. And that is a big, big change. Confidence has managed to sort of continue to be there, but as you can see, the trend is down. And overall business confidence in Australia is moving in the wrong direction. We are probably and likely to see some pretty big volatile events. We do have a federal election down here. We have a state election in our largest state in New South Wales. You've also got a scenario where the financial conditions in this country were coming through. We have a housing slowdown market. We had really got very, very hot here. There's no doubt about that. Sydney and Melbourne particularly had some of the highest housing prices on the planet. And that needed to ease, and that has started to happen, which was good. But you can see here that the overall financial space is starting to slow down. The demand and the actual ability to access credit is moving in the wrong direction for all sorts of sectors. So owner-occupier and investor housing credit, you can see there, is moving down and has been year on year for a little while. But we've also started to see that in private sector credit, and that started to moderate away. In fact, we're now at the lowest level we've been since 2014. So that gets back to those business confidence numbers. It is moving away. Businesses taking the idea of I'm going to actually invest and take lending to actually continue to expand their business is moving in the wrong direction. And that, we've known that. The RBA has been pretty steadfast in not moving rates since the August 2016. So it has been a very, very long time since we've seen any form of movements in monetary policy here. But the interesting thing is the Aussie's actually holding firm, and it's not going towards levels that you would expect with this kind of economics. You would probably expect it against the US dollar to be in the 60-cent handle, and it is not. And that's because the Aussie dollar is actually probably also moved very strongly by emerging market levers. So I want to show you this. This is the iron ore price. Australia is the second largest exporter of iron ore behind Brazil. However, the quality of iron ore that comes out of Australia is second to none. And that is why the Chinese soak up Australian iron ore above and beyond any other provider out there, including themselves. Iron ore over the last year and a bit has been well and truly above expectations. Everybody had expected iron ore to pull back with the Chinese slowdown that was expected, steel demand to slow down, blah, blah, blah. However, as you can see from this chart, the appreciation is up. So since February last year, iron ore is now up almost 4%. So this is rebased to 100 in the iron ore price. And the issue and that horrendous event that happened in Brazil in the last couple of weeks has pushed iron ore even higher. And the one thing that has happened here in Australia is that the big main providers of iron ore are actually moderating their output deliberately to try and keep prices at a fairly reasonable level. So that immediately adds an upside into Aussie dollars. It also adds an upside into exports and the value of exports. And part of the reason why the Aussie economics have actually been pretty good, despite all of what the charts I showed before, is because net exports have been well and truly above expectations and adding quite a reasonable amount of percentage points into GDP. But it's not just iron ore. It's also the fact that the Aussie dollar is an emerging market quasi-trade. And I think this chart, I love this chart, is the MSCI Emerging Markets Index versus the Aussie dollar. And you can see how tightly correlated it tracks. And now last year was a horrendous year for emerging markets. The steel tariffs and aluminium tariffs that the president put on the globe, coupled with the US-China trade war, clearly put a massive downward trend on Asia. And that is basically the majority of the MSCI Emerging Markets Index. But for China specifically, if you look at the A50, if you look at the Shenzhen, so the CSI 300, they had terrible years, as much as 30% declines. But what we saw at the back end of last year and the start of this year already is that there is deep value in Asia and deep value in those markets, and they've popped up. And you can see the Aussies have gone with it. And you continue to expect that if China does continue to cut its interest rates around reserve requirement ratios, stimulate itself, trying to keep growth at around 6.5%, which I think it will, the Aussie will follow that, as you can see from this chart, more likely than actually following domestic demand. The other interesting thing around all of this is the RBA, and I call it a Gryphon for one very good reason. It wants to be hawkish, but it's probably turning dovish. And even within what's happened this week at the RBA meeting, and also then a very, very prominent speech by the governor and Philip Lowe, he has removed the discussion and the language that he had, which was that the next move is likely higher. He's now actually saying it's more balanced, and actually either a rate move up or a rate move down could actually occur. And that is a dovish movement. So the initial reaction to what happened at the first meeting for 2019 at the RBA was a spike in the Aussie dollar. His speech actually caused quite a large decline. It was quite interesting on that fact. And as you can see here, I said it was more hawkish, this first statement, but did acknowledge the downside risk in growth and inflation. There is concern around housing, credit supply, and consumption, which is what I showed you in those first couple of charts. GDP forecasts were moderated, but they're still expected at 3%, and that gets back down to iron ore. But it's not just iron ore, it's copper, coal, and also natural gas, the 4 largest exports from this country. They are still holding things up, and therefore growth is expected around 3%. And there's no meaningful change out of any of what's been said to their overall view of policy. And that in itself, I think, is quite interesting because it is trying to be all things to all people, and that's why I call it a Gryphon. It's clearly a hawk at one end and a dove at the other. This chart, I love this chart. This is produced by Westpac, and it shows very clearly what's happening in the Aussie dollar and where it's moving. And it uses the language that they use as a gauge. What they do keep saying is that the Aussie is remaining inside its target band of between 70 and 75 cents, which means it's got quite a lot of space because it's right in the middle of that band. And if we see what I expect to see probably over the first half of 2019, which is that China probably starts to appreciate, it could more likely move towards 73.5 than actually moving lower. It also feeds into that US dollar story that I started with of a US dollar moderation, and that emerging markets currencies are likely to do that. The quasi-emerging market currency in the G10 is the Aussie. And therefore you could actually see it moving up, which in itself is interesting because it will be actually probably a bit of a drag domestically, but would make sense globally. I think that's the best way to explain it, and probably leave it from there. With that, thank you so much for listening to this presentation. If you do have any questions for FP Markets, as you can see, there is communication on screen. Thank you very much for listening to my presentation, and good luck in 2019.